If you scroll through financial social media, you've been sold a lie. You've been told that to be a successful trader, you need to wake up at 4:30 a.m., stare at 6 monitors, track the 1-minute chart, and execute 50 trades a day. They call it day trading, and they promise it's the fast track to freedom. But let me ask you a question. Have you ever looked at the billionaires who actually run Wall Street? Warren Buffett, Jim Simons, Stanley Druckenmiller. None of them are sitting in front of a laptop screaming at a 5-minute candle printing. In fact, the most successful investors and systematic traders on earth do something completely different. They slow the game down. They anchor their strategies to a single powerful view, the daily time frame. In this video, we are breaking down the exact mathematical, psychological, and structural reasons why the daily chart is the absolute king of time frames, and why the world's wealthiest market minds completely refuse to day trade. If you want to stop gambling and start trading like an executive, let's dive in. The first reason the world's best traders focus on the daily chart comes down to information theory, separating the signal from the noise. On lower time frames, like the 1-minute or 15-minute charts, price action is pure chaos. It is heavily dictated by random order flow, high-frequency algorithms hunting liquidity, and emotional knee-jerk reactions to minor headlines. An asset can look violently bearish at 10 a.m., flip wildly bullish by lunchtime, and finish the day completely flat. If you trade down there, you aren't trading a strategy, you are trading random noise. The daily candle changes everything. By waiting for the daily close, you are looking at the ultimate net result of the entire day's battle between institutional buyers and sellers. All the intraday noise and fake-outs are completely smoothed out. What you are left with is a highly reliable, mathematically sound trend. When a daily chart tells you a market is shifting, Wall Street is actually moving. When a 5-minute chart tells you a market is shifting, it's usually just a blip. Let's talk about the silent killer that day traders never want to show you on their spreadsheets. Transaction friction. Every single time you enter and exit a position, you pay a tax. Even with zero commission brokers, you are paying the bid-ask spread, exchange fees, and slippage. If you are a day trader executing multiple trades a day, you have to hit an absurdly high win rate just to break even after paying the house. You are running a marathon with weights tied to your ankles. But look at a systematic daily swing trader. Because you are trading the daily time frame, your trade frequency drops dramatically. You might only take 2 or 3 highly deliberate, high-probability setups a week or even a month. Because your profit targets are capturing massive, multi-day or multi-week structural moves, your transaction costs drop to a fraction of a percent. You let the market do the heavy lifting instead of giving your profits away to the exchange. The third reason billionaires don't day trade isn't just about the math, it's about human psychology. Staring at candles printing in real time forces your brain into a constant state of hypervigilance. Your brain gets flooded with rapid shots of dopamine when you win and cortisol when you lose. This psychological stress inevitably triggers the 3 deadliest traps in trading: FOMO, revenge trading, and moving your stop losses mid-trade out of pure panic. Day trading turns you into a high-stress gambler reacting to ticks. Trading the daily chart shifts your entire psychology from a gambler to a corporate executive. Because a new candle only prints once every 24 hours, you don't need to watch the screen during market hours. Your routine simplifies. You look at the charts for 20 to 30 minutes after the daily close. You check your system, evaluate if a rule was triggered, set your orders, and walk away. It completely removes emotion from the equation, giving you clarity, objectivity, and most importantly, your life back. This brings us to the ultimate secret of how billionaires and megafunds actually scale wealth. They understand that real wealth is generated by compounding major macro rotations, not capturing micro scraps. Think about it logically. If you are managing a $100 million or a $1 billion portfolio, you physically cannot day trade. There isn't enough liquidity in a 5-minute window to move that much capital without destroying your own entry price. Institutional heavyweights operate strictly on higher time frames. They build positions over days and weeks, using the daily and weekly charts as their primary maps. When you trade the daily time frame, you are finally aligning your retail capital with the exact same footprints left behind by the smart money. You are moving with the tide of global liquidity, rather than getting tossed around by the ripples. If you are currently exhausted from staring at charts, frustrated by choppy lower time frame losses, or feeling like trading is taking over your life, it's time to change the rules of the game you're playing. Switch to the daily chart. Slow down your execution. Build a systematic approach that only requires a few minutes of your evening, and let the macro cycles do the heavy lifting. Treat trading like a disciplined business, not a casino. If you found value in this breakdown, hit that subscribe button, drop a comment below letting me know what time frame you currently use, and share this with a trader who needs to see the bigger picture. Stay disciplined, manage your risk, and I'll see you on the next daily close.